Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jon Ferro, along with Lisa Abramowicz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Wei Li, I'm pleased to say, is with us now. Wei, I want to go straight to that inflation call and go back to what you told us at the start of the year, where essentially what you were looking for was inflation to come down a little bit more, then pick back up towards the end of the year. Are we seeing that pickup maybe ahead of schedule?
That's possible, but I would note that the 2 consecutive months of inflation upside surprises came from different sources. So the January bumper print was mostly because of core service, and the February print was driven by hotter than expected goods inflationary pressure. So I think the jury is still out there in terms of if we are seeing the trough of this inflation roller coaster. Our view is that actually there is room for goods deflation to bring inflation down further. But when that runs its course, which is more likely later this year rather than now, service starts to dominate. And that's when wage pressure pushes inflation higher. And ultimately, we're looking at the trend settling around 3% rather than 2%. But that roller coaster is for later this year rather than right now. And right now, I think the bar is pretty high for markets to abandon this narrative of immaculate disinflation, which is why we're positive on risk sentiment and we're positive on U.S. equities at this moment.
Before we get deeper into equity markets, Wei, how do you think that's going to influence the thinking of Chairman Powell in today's news conference?
Well, it's likely going to be a very balanced press conference and very balanced FOMC. They will emphasize data dependency. They will try to strike a balanced tone. You know, the last meeting, they talked about a sticky last mile. So I am very curious in terms of how they speak to the recent upside surprises in inflation prints. I'm also curious in terms of if they're going to revise growth higher, inflation higher. They're going to start discussing the Fed balance sheet runoff, maybe trimming that a little bit. So lots of things at play. But more broadly speaking, we are expecting dot median to stay at 3 cuts for this year, which is in line with our expectation at the beginning of the year. So now markets finally moving closer to that.
Before shifting to stocks, what duration of bonds do you feel is most vulnerable, given where pricing is and given what you expect to transpire with inflation later this year?
While we have a preference for short end of the curve and also the belly of the curve. So implicitly, there is a steepening view over the longer term. And that is more of a fiscal story, right? So if you look at the fiscal deficits in the U.S., late 2022, we're looking at 3.5%, and now we're getting to 8%, and that servicing cost is increasing, expected to increase even more, the higher rates for longer, and term premium needing to come back. So all of that points to higher rates, especially for long end of the curve. But when that kicks in, when that repricing because of concern around fiscal dynamics and debt serviceability, that's key, which is why our conviction on the long end of the curve, yields moving higher, it's stronger over a strategic horizon than over a tactical horizon of 6 to 12 months.
Are stocks vulnerable to a hawkish surprise from the Fed, or are they operating according to a different set of rules that really hinge on very different factors than Fed set rates?
You asked the question, Jay versus Jensen. So I think that's what stock markets are trying to figure out as well. But if year to date is anything to go by, we have had hawkish repricing of the Fed, like 7 cuts at the beginning of the year to now just 3 cuts. And yet markets are very resilient. S&P is up close to 9%, equal weighted S&P close to 5%, right? So this is not a market that are caving in under hawkish repricing pressure, and the bridging factor, the reconciliatory factor here is the strong earnings, and a lot of the earnings are being heavy lifted by the AI theme, which is why we are positive on U.S. equity market, because earnings are coming in strong and stronger, beating expectation, and we lean into AI because that's where actually most of the earnings momentum is coming from.
Given that way, do you think that calls for some sort of broadening out in the rally are premature, just simply because the gains still are concentrated, not just with magnificent 4, 3, or 2, or whatever people have got whittled it down to, but also only the companies that are most leveraged to immediate benefits from some of this technology?
Well, I think there is room for S&P to broaden out from the very concentrated leadership that we saw for most part of last year. But that can also be thanks to AI. So as we think about sectors like healthcare, sectors like industrials, starting to adopt AI to a greater scale, the leaders within those sectors are likely able to broaden the gap versus the rest of the peers within the sector, because they have economy of scale, they have a lot of data to play with. So we can see actually AI driving broadening out of the rally concentrated in tech so far. So that's one way that it can broaden out. Another way that it can broaden out can be a wild swing of rate repricing, right? So we're talking about 3 cuts now. And remember, at the peak hawkish moment of October, markets were still looking at 2 cuts. But we have really seen a wide range of rate repricing, which is also evidenced in the very high elevated rate volatility, the move index. So there's no telling if we could see swing back of this rate repricing, and when that kind of tactical momentum plays out, that could benefit the broader market beyond the AI concentrated theme. But that's so short term because we have seen wild swing within short periods of time. That's not something that we're positioning our investment views around, but we acknowledge that this can swing within this short period of time.
So, Wei, I know you're overweight US equities, but also a sprinkle of Japanese stocks. Can we finish there? The Nikkei 225 is up by almost 20% year to date. It's been quite a run. Can you tell me how the Bank of Japan, in any way, shape or form, is relevant to that decision?
Well, it's the prerequisite on which the micro story can play out, which is our expectation and rationale behind our Japanese equity call. So we upgraded Japan twice last year, and we continue to like it at this juncture, even as it crossed the all-time high last made in 1989. So yesterday was a key event for us to watch. So if they are very kind of hawkish, viewing inflation as a problem, I would be somewhat concerned with our Japan call. But frankly, yes, they hiked rates for the first time in 17 years, but they hiked it in the most dovish way possible, right? So for example, they nominally dropped yield curve control, but they're still saying in case of a rapid rise in long-term yields, they would make nimble responses, adjustments. So if that's not the definition of YCC, I don't know what is. So they really kind of very supportive and accommodative still, and that paves the way for micro positive developments to continue to be reflected in Japanese equity pricing.
Well, that trade is working out. Wei Li of BlackRock. Wei, thank you. Steve Major is with us around the table. Steve, good morning to you.
Morning, John.
Can we start with that mildly bullish story for Treasuries? Yeah. Why mildly bullish in the face of a bit of a sell-off we've seen so far this year?
Well, mildly bullish is not all in. All in is full-on bullish, and that's why Europe is ranked above the US in terms of possible easing and performance from duration. But we can't let go of this view that yields are going to be lower, not higher, by year end. And I get they've been sliding up the last week or so, and I mean, the context is important. We've come a long way from the peak in yields in October. The inflation peaked in June 2022. The market changed its directional view on rates in October 23. The Fed pivoted a couple of months later. It seems to me that they're not going to change their mind. The next move is down. And in the meantime, we know it's either unchanged or down for policy rates. And therefore, the trade is sit in the belly of the curve. If not treasuries, you take IG credit. And if you can't take those, then you, what's it called? T-bills and chill. Is that what they say over here?
That's what they're saying stateside, yeah. T-bills and chill.
I've been here long enough now to
Picking
get
up the lingo.
Yeah.
Let's go further out along the curve, get away from the belly and go out to the 10-year, say.
Yeah.
What backs up this call at the moment that yields at the end of the year will be lower, not higher?
So if you took the most hawkish individual in the December dot plot, you get a longer run equilibrium rate just below 4. And you get very little rate cuts in the next year or so. So if you just took that as a path for rates, it's difficult to get the 10-year yield much above 4.5 on our calculation. And you'd be really going some to get to 5. So just knowing that right-hand tail of the distribution is sort of in at 4.5 and change, I quite like the idea of being long. Now, it's very difficult to time this, and that's why the best trade, which I think everyone seems to be doing, is owning the corporates, taking all the new issues they can, and complementing a position in IG credit with T-bills. And that generates a total yield of between 5 and 6 that competes with equities. And on a risk-adjusted basis, it's superb. So I think that's what's going on. If you're in T-bills and they're maturing, you've got the option to roll them again or go and buy something else. Now, the thing is with buying the 10-year Treasury, you drop 100 basis points in yield. But at least if you go to IG credit, you can sit and wait. And I think that explains the tight credit spreads. I don't think we can infer too much reason in the credit spread as to say something about default probability. I think it's the all-in yield that people like. They can't get enough.
I was very excited to speak with you today because for so many years, I remember all of the people who are calling for some huge sell-off in treasuries, and I'd get the major letter, and it would come out and say, you're all wrong, yields are going lower, because basically we're looking at a low inflation, low growth reality. That was before the pandemic. A little bit after the pandemic, it sounds like your thinking has shifted somewhat, given the fact that you're not aggressively bullish in treasuries. Has it? Has the neutral rate shifted? Has something about your view of the world changed?
The quote that John lifted is for our March asset allocation, so it's the monthly, right? So the view hasn't changed. Our year-end forecast is 3.0. That seems a long way from here, but believe me, once they start cutting, the market's going to move quickly. And this is the issue that people have, is that it's very dangerous to be short of treasuries here. You've got to have a very interesting narrative to justify being short of treasuries. So the minimum you can be is neutral and small long. I think that the growth narrative has been the biggest challenge. And if I put together what explains US exceptionalism, it's the fiscal population growth, maybe even some productivity, who knows. But the thing is, that explains what's happened in the last year or so. It doesn't tell you the next 10. The 10-year Treasury yield should reflect the average over that period. Does anyone really think that 3% real GDP is going to be the case for the next 10 years? Because it looks to me that that's very unlikely.
But maybe not. Maybe the growth story isn't going to be there. But there is an argument for the inflation story to be there, especially given the election, especially given more protectionist policies, especially given some of the issues that are not going away with respect to wages and just the fiscal money that has been, pro-cyclical, which is sort of counterintuitive. How do you dismiss all of that?
I don't want to dismiss it, Lisa, and you're right. The last bit on inflation has been sticky, but the big picture, where we've come from since June 2022, it looks like a symmetrical reversal. So it went up and it came down. We're not quite on the target rate yet, but they don't have to arrive at the target before they cut rates. That they would be almost irresponsible to wait until after they've hit the target. I can't dismiss what you're saying. I don't dismiss it, because to me it's about probabilities and scenarios. So the sort of no landing scenario whereby inflation stays sticky and high, growth ticks along, that says there's no rate cuts this year, in which case 2-year yield should be 5.25, 5.5. I get it, 10 should be 4.5, 4.75. That's sort of where they would land with no landing. But soft landing is where we are today, and we've got this risk on the left-hand side of the distribution here of a hard landing. Has it really gone away? This time last year, people were cancelling meetings. cancelling meetings with me. It's an easy thing to do anyway. But,
Thanks for failing.
No, because it was the regional bank stress. Right? People say to me, what does a hard landing look like? Well, the first thing is this interview doesn't happen. Right? So it's, people have forgotten a year ago, for a good few weeks, we had the smell and the look of a hard landing. 2-year yields were screaming down towards 3%. Right, so I'm not saying that I know anything that's going to bring that back, but it's just about probabilities. It seems to me that we're leaning a bit towards no landing, soft landing, stagflation. That's what it's all leaning towards. And to me, bonds protect you in case that's wrong and you go back the other way. So that's the explanation, Lee. So I can't let go of the fact that I think rates are going to be coming down, and when they come down, the market will price more, and that's how the bond yields get down to a lower level.
So that was Q1 last year going into Q2, and then Q3 we printed something like 5% on GDP stateside, which is kind of wild. And then we were seeing the highs of the year on a 10-year and on the 2-year in October of last year, as you mentioned. And I don't remember something you said about supply and some reflections you had at the time about whether supply matters or not. And now the answer is it depends. Can we talk about what it depends on? And the fact of the matter, to Lisa's point, that we've got this sort of pro-cyclical fiscal policy in the US now where deficits are massive with unemployment south of 4%. Does that matter to the ultimate call?
I was here this time last year and we discussed it, and yields were pushing towards 5 for the 10s, and it was on the supply-demand imbalance. Looking back with hindsight, maybe the Treasury made a misstep with the amount of coupons they issued at that time, given the GDP, the downgrade, the inverted curve. I mean, it's easy for me to sit here and say so afterwards, but it looked like that was a misstep, and it was addressed in the November refunding. Now, I think that on the whole, supply should not matter to your yield forecast. It can matter to your near-term tactical view if there's an auction coming up or there's some kind of thing. But, the supply impacts term premium when there's a surprise and there's an imbalance. In the longer run, I think the stock of debt, the huge stock, and let's remember it's virtually doubled in the last 2 administrations under both of the last 2 presidents. We're at close to $27 trillion of marketable securities. That's double early 2016. So that weighs on future growth, and that pulls the R star down. Everything else being equal. The way that happens is through debt servicing. So the way that bond supply deficits feed into the way the bond market behaves is 2 different things. There's the imbalance which can hit the term premium, lift it up, short term, and there's the longer term, what it does to the equilibrium policy rate. And I think there's unambiguous evidence that the stock of debt weighs down. So it opposes the positivity of the population growth and the near-term impulses that might come from AI, etc. But the debt stock weighs the other way.
Yesterday, just to put a bow on all of this, Mark Cabana of Bank of America was saying that maybe bonds should take a message from stocks that keep flying, and that it shouldn't be stocks taking a message from bonds. Do you push back? Do you saying that actually stocks seem to be listening to a risk that's getting baked into bonds, which is why yields are not even higher?
I said that's a great debate. I mean, it's an interesting insight. Why not? We're always looking at new ways of valuing bonds, but it seems to me that the yield on the 2-year Treasury you can see quite robustly and justify it based on the path of the short rate. And so if it's 470-ish, it's reflecting a Fed that cuts a couple or 3 times this year, continues next year. That's basically what it's priced. Now, that's an important number because it affects the 5s and it affects the 10s. Now, I think equities seem to be taking the positivity from what the bonds are telling them, so that rates are coming down. I think bonds are purely priced off of the short rate and its path, so I don't think that they're priced due to equities at all. But it's an interesting debate. I mean, I'd like to see how we could use equity risk premium to influence our valuation on bonds. I don't think we can. It strikes me that it goes the other way. Unambiguously, it's bonds to equities, I think.
On further hikes, Steve Major's with us of HSBC, with us here in New York. Steve, got to talk about this. First move from the BOJ, first hike since 2007, and proving not to be so consequential. The yen moving in the other direction. How are you reading developments in Japan?
Maybe it is consequential because maybe it opens the door up for the next step, the next move. Because if you were scenario role-playing before this event, you would have said, imagine a scenario where they went all in, when they'd rate hikes, end the yield curve control, end this, that, and the other, really hawkish, and dollar-yen went up. And actually, that seems to be what's happened. So to me, the totality of the decision and the outcome in the asset markets is the measure of success. So you have to look at all the different details in what they did, and then how all the asset markets play out. And they're watching this closely. I would say that net, it looks like there's room maybe to do some more of something. Now, from a JGB perspective, maybe it means yields can keep going a bit higher. Dollar yen is that's probably not what they want to see.
Well, that's what we're getting to. Sort of to define success, I need to understand what the objective was.
Yeah.
Surely the objective wasn't to see a weaker Japanese yen off the back of this.
The key performance indicators for this one would be not to break anything or make any mess. It's a bit like any big decision from any central bank. First stop is don't make a mess of anything. So in that regard, it's okay. But it just seems to me that it's not really over. There's much more that could be done. The fair value for JGBs with this rate move and the changes on the yield curve control could be nearer to 100. And it's interesting that it's the currency that moves, and that tells you that maybe investors are putting their views through the FX markets more than they are through the bonds at the moment.
So a lot of people are saying that the Bank of Japan is not going to be bothered necessarily by this move in the yen. Do you disagree?
I think they'll be delighted just to have got rid of negative rates. So in that sense, I totally agree. They're not bothered at all, because if their objective was to get the rate up without making a mess of anything, then they've achieved it. But I think it's the totality of the asset class response that matters, and that takes time to look through. It's taken them how many years? 17 years to get here, and it's step by step. So I think it's conditional, Lisa. I think that their analysis will it'll be ongoing, and they'll be looking at what's happened to dollar yen and to the equity market and to bonds, and that will help frame what they do next.
What was interesting to me was a lot of people were saying that maybe if the Bank of Japan ended negative rate policies and actually tightened more significantly, all of the Japanese investors who had been pouring their cash into U.S. credit markets, into European markets, would come home, and that buyer base would not be there in the same level. Do you see that as a potential likelihood, or is what we're seeing what we're getting, which is essentially the dynamic is kind of the same?
I think that the Japanese investors are still very happy to hold dollars, and there's such a big yield gap between the two. That's the thing. For there to be a change in the direction of the yen, clearly more has to happen. If you told me today that policy was being shifted in a way that dollar yen would head back towards 140, then that changes everything. It changes all the hedging strategies, but obviously they haven't done enough to change the direction. So I'm not saying this for sure, but it strikes me that the outcome of this could be that there might be more moves, more iterative steps, especially on the JGB side.
Which raises this question about the threshold for today's Fed meeting and how hawkish Fed Chair Jay Powell would have to be before you see a move in the yen that would actually cause the Bank of Japan to say, wait a second, maybe we need a second step.
Yeah, I think that's unlikely. But given what we've just seen, why not, though, Lisa? Given if we'd sat here, if we'd sat here last week and called higher dollar yen on the basis of what we've just seen, it would have been an outlier. So why not? Let's go with it, right? So Chair Powell goes hawkish again and says it was a mistake. What I said before, he's not going to say that, right? The one thing you can say for sure, you know.
What else
he's not going to say.
Powell's capable of going off script sometimes.
He's not going to say.
Not like that.
We can guarantee that's not going to be said, right?
Yeah.
Steve, just a final one. Steve, can we reflect on the previous decade or so in this fixed income market? I was in Europe, we were there together, we used to talk about negative bond yields, and Lisa, what did we get up to? 20 trillion? Some ridiculous number of negative yielding assets. What was that period? How would you describe that period? And for those that maybe have just joined the industry and weren't living it, how would you describe that period to them?
Well, it was an experiment in monetary policy, and it was obviously a scary time because the policies were there to address the risk of deflation. The counterfactuals, we don't know what would have happened without some of these policies. I think they get a bad rap, negative rates. I'm not saying I'm a fan or anything, but it's just that they get a bad rap. And what else were central banks supposed to do? Honestly, so I look back at it and I think it was an experiment, and it might have had some quite serious unintended consequences because, well, it shouldn't have been a surprise that asset prices went up so much on the back of this.
How would you judge the success, though, of them?
Well, as I say, it's the counterfactuals. So how many people would have lost their jobs without this? And there's been analysis on this from the Bundesbank and from parts of the ECB. I mean, this is the thing. Did negative rates actually keep the unemployment rate lower than it would have been otherwise? And that's a really important thing. You can't measure just how important that is for society. So if we just look at negative rates and say, oh, look what they did, they created all of this asset price bubble and all this, that's not... The full analysis is going to look at the real economy and especially employment.
And how much worse it could have been. Steve?
Yeah, exactly.
Fantastic to see you. It's good to catch up. Steve
Likewise,
Major of HSBC. Just remind me that price target, 3% 10-year yield?
Yeah.
That's the yield target year end on a 10-year? Okay.
He looks slightly in pain when he talks
You're going to
about
join us before year end? I've got to go over
I'll
that.
be happy if you'll have me.
Of course, always. Hatzius and the team over at Goldman Sachs, falling in line with the broad consensus, expecting 3 Fed rate cuts this year. Hatzius writing this: inflation has been firmer in recent months, but we think it is still on track to fall enough by the June meeting for a first cut. This has become less obvious, though, and our inflation path for the rest of the year is now at a range where small surprises could have large consequences. Jan, I'm pleased to say, is with us in the studio in New York. Jan, good morning to you.
Great to be here.
Fantastic to catch up with you, sir. I remember the outlook to start this year, and we talked about it a lot on this programme. The hard part was over. It's almost easy from here. Do you still think that's the case based on the data we've had so far this year?
Yeah, it's more of a question because of the stronger inflation numbers. But I think if you look at the trends, we're still on track to get down to the 2.4% range or so for core PCE inflation by the fourth quarter. Now, at the start of the year, we thought that was going to be 2.2%. So that's been, a little bit higher. We've basically gone back to the forecast that we had last fall. But 2.4% is still, pretty good progress. And by 2025, I think we'll be at 2. If you look at the drivers of inflation, whether it's on the goods side or on the rent side or in the labor market, I think the trends there still look encouraging. But of course, the prints have been higher, so there's more of a debate about it. And the Fed is going to be responsive to kind of near-term surprises.
Well, let's talk about how responsive they might be today. As we know, clear and obvious risk factor is in the dot plot, whether that median dot shifts from 3 cuts, say, to 2. And as we all know, it only takes 2 officials to move in that direction. Do you think that's something that happens today? Is that a base case in today's meeting?
It's not a base case for me, but it certainly is a possibility because not that much has to change in terms of the projections. If you go back to 2 weeks ago when Chair Powell testified in Congress, he said they were, pretty close to having enough confidence. So that sounded like, a cut no later than June. If you take the statements there, we've had higher inflation numbers in the past week. So the question is, has that changed his view? My expectation is no, but we'll find out at 2 p.m.
All things being equal, it seems to have changed your view on the margins. You shifted down to 3 rate cuts expected for this year from 4 earlier in a report in the past couple of weeks. And you said this line that John noted: small surprises could have large consequences. What do you mean?
Well, if you have a few additional tenths of inflation by the end of the year, even if it doesn't really change the overall trend, 2024 is still lower than 2023, but they would deliver less cuts. So in that sense, I think it'd be a continuation of what we've seen in the last several months, where in the early part of the year, with an expectation of inflation coming down to very close to 2, I think they would have done more. But now it seems like the December dot plot and the December inflation forecast looks pretty reasonable to us.
It seems like people are split on their views based on whether they think that the neutral rate has shifted materially or not. You believe that the neutral rate is still going to be around your previous projections of 3.25% to 3.5%. How do you push back against people who say it's actually 4% or higher, like Elsa Linos of RBC Capital?
I think we don't know, and I wouldn't push back very hard because the confidence interval around any of these estimates is quite high. 4% though is still well south of 5 3/8, and I am pretty confident that at current levels we're in restrictive territory by a significant amount. But whether the right number, is 4 or 3.5 or 3, that's harder to know. I do think that the FOMC projection, 2.5%, if you take the median, that looks pretty stale. And I think that is going to drift up over time, probably by a little bit today, although we've been waiting for this for a while, and so far it hasn't happened, at least as far as the median is concerned.
You're a precise man and very careful with your words. When you say we're in restrictive and significantly so, what guides that? Where does that come from?
I think all models of neutral rates, and they're all pretty imprecise. This is not precise. There are many different models. Each of them has a significant amount of error, but you're going to be hard pressed finding a model that says 3% plus on the real rate, on the real funds rate is neutral. So it's really guided by a variety of different models. Some developed at the Fed, some developed elsewhere that say right now we're outside that range of uncertainty.
Can I ask you this question then? If I was a first-year intern at Goldman Sachs, I'd create a model really quickly and I'd say, Jan, unemployment's south of 4%, equities are at all-time highs and credit spreads are super tight. Why is that a bad model to sit here and say that maybe we're not that restrictive at all?
Well, so there's kind of short run and long run. So I don't think that the current level is very problematic in terms of near-term growth. And as you know, our forecast on growth is well above the consensus and continues to be. But over time, once the kind of short-term moves in financial conditions, short-term moves in fiscal policy and other forces play themselves out, I think it's pretty clear that the current level is above normal kind of neutral levels. And so over the medium term, it's very likely that we will see declines in rates, but the time path is going to be guided by the data.
So you don't think it'll be important for Jay Powell to push back against some of the record highs on stocks and some of the tightening in credit spreads?
Well, he would never comment on near-term market moves, of course.
Right.
So you say that, but actually I remember that meeting where that journalist, and it was an honest mistake, said to Powell that markets were rallying. And I remember his response to it in the news conference, and we all talked, I think it was Jim Bianco of Bianco Research that called it Powell's hawkish hits. He just came out, and the hawkish tone that he used once he thought that markets were going against what the Federal Reserve was trying to guide them to, I think was pretty stark, strong, maybe even profound. Why isn't that an option he could take today? In the face of CPI that's coming in pretty hot, we've taken out cuts and this market's off to the races. Why wouldn't that be something that he'd be concerned by?
I don't think it's a problem because I don't think he's trying to slow things down significantly. I mean, the unemployment rate has drifted up somewhat. We're still seeing rebalancing and job openings. The quits rate is coming down. Inflation is going down. The sequential numbers have been a little higher, but the year-on-year rate has continued to come down. I don't think he's going to be particularly worried about having to squeeze the economy. He can respond to surprises by delivering cuts a little bit later, delivering cuts a little bit earlier, but I don't think we're in a very different situation from where we were a year ago or
this
certainly
is the
2
change
years
you've
ago.
identified too, and it's implicit in your forecast. And you're right to point out that your growth forecasts have been above the street ever since you came out with your outlook. Strong growth doesn't appear to be a problem to the Federal Reserve. Why is that? What is different about this moment?
Well, because I think inflation is much lower and it's heading down, and the year-on-year rate is still heading down. The labor market is much closer to balance. So inflation expectations have continued to come down. They've now largely normalized. So all the things that Fed officials were very worried about a year and a half ago that you'd get anchoring of inflation expectations, you'd get a wage price spiral. I think a lot of those things have moved into the rearview mirror. And so therefore they are much less concerned about easier financial conditions. They'll still be relevant for setting policy, but they're going to be much less of a concern than maybe in this episode that you mentioned.
Jan, this was great. It's always fantastic to catch up, sir. It's been too long. It's good to see you.
Thank you.
Jan Hatzius there of Goldman Sachs, breaking down his outlook for the Federal Reserve and this economy.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.